mates.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we help you learn to invest in roughly 20 minutes or less. We break down the world of investing from beginning to dividend so that you can hopefully make some returns. My name's Bryce, and as always, I'm joined by my equity buddy, Ren. How's it going, bro?
It's very good, Bryce. How are you?
Good. Just having a bit of a laugh before we started because the way that we do our synchronization when we're not in the same room recording is to do a countdown over the phone. And if there are some scientists out there that can explain that there is a lag between phones, I would love you to write in and let Ren know.
The Price is just a little bit slower on the countdown than I am.
No, there's a lag.
Mate, we live in a global, interconnected economy with, satellites in the air, beaming things in fractions of seconds, and somehow you count down a full 2 seconds later than I do.
No. As much as technology has improved the lives of everyone, there is still a lag between phone calls. So,
mate,
someone please write in and let us know that is the case.
There are traders that execute trades in fractions of a second from the other side of the world.
You and I aren't running a copper cable between our ears at the moment. So, you're relying on Vodafone. And anyway, let's...
Telstra, but anyway.
Telstra. Anyway, we are here to chat stocks as always, Ren, and this episode we're going to revisit a segment that I think we've only ever done once before, and we had full intention to do many more, but as always, there is just so much to talk about. We haven't revisited it since, and that is our series on meeting the investor. And so to recap, the idea is, and for anyone that hasn't listened to the previous episode or has just joined the show, welcome. But the idea is that in this episode, we're going to introduce you to an Australian investor, famous or otherwise, and give you a bit of an insight into the way they invest. And we'll play a few clips, audio clips from this gentleman speaking, and we'll sort of have a chat about some of the clips and go from there. So, Ren, do you want to give the intro, who the investor is, and then we will jump into some of his thoughts?
Yeah, for sure. So, as you said, this is the second one we've done. The first one was Kerr Nielsen, one of Australia's best investors. And this person we're about to introduce is also one of Australia's best investors. And I guess this is the point of what we do with this Meet the Investor segment. It's an opportunity for, most of our audience is Australian, but wherever you're listening, to get to know some of Australia's best investors, because we all know a lot of America's best investors. Warren Buffett, is a name that everyone sort of knows, but there's some guns in Australia as well. So without further ado, this episode is on Paul Moore. So Paul Moore he's had about 35 years of experience in the industry, starting in 1985. But when he really came into his own was in the mid-90s, when he assumed responsibility for BT Markets funds, who outperformed in the mid-90s. And then in 1998, he started his own fund, PM Capital. And since then, Paul has been running PM Capital. He's got a number of funds, a couple of listed investment companies, one that we've actually spoken about on the show before with Andrew Brown, which was PM Capital Global Opportunities Fund. That was probably episode 5 or 6 of our podcast. The first interview we ever did, Andrew talked about the opportunity to invest in that company at lower than its tangible asset value or its net asset value. So Paul has been someone we've sort of been thinking about for a while, and look, one day we hope to get him on the show, but until then we will make do with introducing him to all of our listeners and hopefully learning a thing or two about him ourselves through some audio clips that we've been able to dig up from some interviews that he's done.
Yeah, so let's get stuck into it. The way this is going to work is we'll play a clip that we've found from Paul over the last few years, talking about all different sorts of things, and then we'll either give a bit of commentary ourselves, and then we'll move on to the next one. So, I think in the interests of keeping this short, sharp, and snappy, we'll probably not try and give too much commentary. This isn't a Meet the Equity Mates episode. No,
that's
no.
all other 100 odd episodes that we've done.
Yes.
So I think, without further ado, let's start at the beginning. This first clip we've been able to pull out is Paul talking about his first investment and some of the things he learnt in those early days.
Paul, 30 years in the industry, you're going to have to cast your mind back a long way to answer this question. What was your first investment? What got you started?
First investment was back in university days, and it was actually an investment in Blue Metal Industries. I acquired it from a family member, so probably not a lot of work done on it, but it was like jumping in the pool, getting started, and actually got lucky because it got taken out by Boral, so it was a positive experience. And then I actually rolled that into Carlton and United Brews, and again, more an instinctive purchase. I don't think there was too much work on the financials, or
you were just doing some product testing through university, I imagine.
That probably was what kind of triggered it. Anyway, I got lucky with that one too, in that Elders IXL purchased it. So first two experiences were fortunate, but not a lot of work done on them.
Okay, there you go. So a bit of an insight into Paul's first investment. So now, Ren, let's jump into the second one, which was all about the most important advice is backing your own conviction.
30 years in the market.
Thanks for reminding me.
Yep, 20 running your own business. Undoubtedly, you've taken a few scars along the way and learnt a few things, and it's probably changed or influenced the way that you invest now. It's part of developing experience.
Yep.
Talk me through something that sort of shaped, something that you look back and you go, I got taught a lesson there, and I'm glad I learnt it. It's made me a better investor today.
Yeah, investing is definitely not a straight line. You have your good years, you have your bad years. Sometimes people think you're a superstar, sometimes they think you're a mug. But what that highlights is that the most important advice I'd ever give to anyone that was starting off on the investment is that you've really got to back your own conviction, make your own decisions, because that's the lesson that's really stood out to me. And it's worked both ways in that, I've had, when you have an instinct about a certain risk reward, I've been talked out of investments that have gone on to go up multiple times. And likewise, I've had red flags in an investment. You don't react to them because of either, one, they've already come down a bit and you think, oh, I'll wait for a better time. You never get a better time. Having the conviction to back your thought process and acting quickly. That's probably the two big lessons.
So the next two clips are both follow on from each other. We've just broken them up to make them flow a bit better. So the first one is on inflation, and then the second clip gets into the effect of inflation and the interest rates that follow it and how that affects different investments, including property.
Yeah, well, it's interesting because when I started my career, which was 30 years ago, we were really at the beginning stages of the authorities dealing with inflation, that experience through the 70s. And so the groundwork had been laid to deal with inflation, and even though it was still high, it was on its way down. And so, to be honest, my whole 30-year career, I've seen declining inflation rates, declining interest rates, which means that most people in the industry, probably 90% of people in the industry, have had the same experience. So really, in terms of how markets react to inflation or the prospect of higher inflation or the potential for a scare in inflation, it's really only from the textbooks for me and most of the industry.
And following on from that clip on inflation, Paul picks up his answer here.
So people have to think differently about their investment ideas, where there's likely to be opportunities to put your capital. It's going to be very different from the 30 years that we've seen. For example, property, prime beneficiary of the lower interest rates that have come from lower inflation. 30-year trend. Don't underestimate just how far we've come and to what an extreme we've come. So over the next 10 years plus, the reality is interest rates are probably going to be quite different to what we've become used to over the last 5 years. It's going to be interesting because the reality is none of us have that experience. If interest rates are bottom, the first thing people have to remember is that the discount rate's going to be going up, which depresses valuations across the board.
So we're on a bit of a theme here. The next one is still in the realm of inflation, and Paul is talking about some of the good and bad investments in an inflationary environment. Obviously not an environment that we've been investing in over the past, well, really since we started investing. There hasn't been a lot of inflation in the market, but at some point the cycle will turn. Cycles always do turn. So as you're looking forward and as we're looking forward into our investing lives, it's probably an important thing to understand what investments do well and what investments don't do well when there's a lot of inflation in the system. So hopefully Paul can help us start thinking about it.
What are the specifics? You said you need to look at a different opportunity set when it comes to investments to what people could invest in or benefit from while rates were coming down.
Yep.
What are the specifics of what you think you need to be investing in now?
Well, you need earnings growth. That's the dominant feature, or a specific reason for being re-rated, whereas historically with rates coming down, everything got re-rated. So to flip the question around, you need to avoid certain areas, and so anything that benefited from lower interest rates, so property is the obvious. Infrastructure, because everyone thought great asset, and typically they are, so they leveraged them up. Now they're being priced for very low coupons. If rates go back up, I think people underestimate how much leverage is in the system, and you saw it with Macquarie Infrastructure Corp down 50% overnight because problem with one of their assets. We've mentioned the consumer previously in terms of they were perceived as defensive. The reality is they hadn't grown their earnings in 10 years, and when interest rates started going up, it exposed the lack of growth. And not surprisingly, things like Kellogg, Kraft Heinz, Campbell's Soup, those sort of consumer names, I think they retracted about 30 to 40% over a 12-month period. We think Ronald McDonald, McDonald's, is vulnerable because it's a property business. If you actually think about it, it's not about selling burgers, it's about how much you can earn from the property you own. And they've actually been selling off their restaurants, really focusing on franchise fees because Wall Street values them most valuably, leveraging up their balance sheet. So we suspect that whole restaurant franchise system has been coming over leveraged, and investors have forgotten that if they get into trouble, who's the backstop? McDonald's or Burger King or Wendy's. So you want to avoid those areas. In terms of where you can take advantage of, we think anything where the earnings are underpinned but they have the ability to grow from here, and the earnings power is being underrepresented at the moment. So a classic is domestic banks, not in Australia because they've got totally separate issues, but Bank America, some of the European banks, Wells Fargo again, because all the issues they went through the GFC and they've been dealing with, they're now got their capital in order. They're now returning 100% of their retentions with the blessing of the Fed. And you're starting to enter a sweet spot in terms of the US economy and therefore their potential to grow their earnings. So the interesting thing is they're on about, if you adjust for their excess capital, they're on about 9 or 10 times earnings, giving it 100% back. So that's an effective yield of 8, 9, 10%, which in a low rate environment is quite phenomenal.
So hopefully our listeners were able to take something away from that. Pretty important to try and understand the impact of inflation. And it's equally important to understand what power the central banks have around the world and how they deal with economic activity. And one way that they deal with economic activity is by quantitative easing. So here's Paul's thoughts on quantitative easing and also the psychological effect it has on markets.
Look, personally, it was the same with the US. I think it was a waste of time. The first one was fine, get us through, but after that, the reality is you're better off focusing on structural reform and government policy. And I think the reason the QE has been so extreme is because the governments and the structural reform's been lagging. But in the end, really what's happening with a lot of this liquidity is just sitting on bank balance sheets doing nothing. You've got to break this psychology. So, I think some will argue that it was an important part of helping that psychology, but I reckon the markets are way ahead of it anyway. They're more focused on whether the structural reform will generally come. So I think it was a bit of a waste, to be honest. And to be, I think my comments previously on the US is the fact if you'd stopped doing that, the markets I think would actually be better off, because what happens as long as they still think the government needs to get involved, or the monetary authorities need to get involved. Oh well, gee, maybe it's not so strong. Maybe there's a few problems out there we have to, and so it actually creates the environment of conservatism. Whereas if they just get out the way, business will get on with investing.
All right, 3 to go here. Hopefully people are taking something away from Paul's words of wisdom. Next one we've got is Paul talking about some alternative investments away from the sort of standard equity space.
People often wonder, how do these anomalies come about? And one of the biggest reasons I would argue is it's process. We've become a very process-driven world. Tick the box, and as long as it ticks the box, it's okay. And what I mean by that, you think alternative fund managers, so we're talking KKR, Apollo, they're basically fund managers. My business. Fund managers should know them pretty well. Pretty easy to value, because if you can't understand your own business, you shouldn't be in the business in the first place. But the interesting thing is they were dramatically mispriced 2 or 3 years ago. You kind of ask yourself, well, why? And the primary reason is process. They invest, or they run their business via a trust structure. And that's actually the way you wanted to do it, because it avoids the extra layer of corporate tax. So for a shareholder, that's exactly what you want. But the way institutions are set up in the US is that their mandates don't allow them to own trust structures. So the process stops them from buying these businesses. So 2 or 3 years ago, on current earnings, they were about 3 or 4 times earnings, which is just phenomenal. And this is how crazy process has become, because of that arbitrage and the way the market was being valued, the owners of these businesses worked out, you know what? If we become a corporate structure allowing these guys to buy us, even though it reduces our net cash flow in our pocket, the valuation goes up because they can buy us. So let's do it. KKR announced it 2 months ago. They're up 25%.
Okay, Ren, so for the second last clip from Paul, this is one that we touched on a couple of weeks ago, and something that you have been trying to, I guess, dig deep and understand yourself, and that is the risks coming out of the ETF sector, and also the impact that ETFs have on investor returns. So this is an interesting one.
Could you talk specifically to what you think some of the risks coming out of the ETF sector is and why they concern you?
And it's more kind of a long-term, high-level type view, in that the one simple rule you can have in investing is wherever they have the biggest crowd is where you're going to get the worst returns from. And it's just like when we go looking for opportunities, you want to look where there's no one else looking. The biggest crowd of all has all been driven by lower rates. So it's the bond market and passive in ETFs. If you look over the last 10 years, don't quote me on the exact numbers, but it's something like $5 trillion of assets have gone into passive and ETF. So it dominates the market, it dominates purchases. And so really simple rule of thumb, if that's where the crowd is, that's probably going to be the worst outcome going forward. And if you think about the fact that interest rates have been coming down, that's kind of what's driven that, because everything benefits when interest rates are coming down. So you may as well just be invested. You don't have to be that particular. But when interest rates go up, you've got to be much more specific about where you invest. And therefore the passive and ETF outcome won't be what I think people expect. Now, the reason I say it's a risk is, if you look at ETFs, to me that's the ultimate in crowd sentiment investing, because people come up with a theme and it's like everyone piles in, and if they want to get out, they pile out. So my suspicion is at some point in the future, because there's so much money locked up into these structures, you're going to have an event and everyone wants to come out. Where's the liquidity going to come from? It's all sellers, no buyers.
All right, last one for today's episode, and we thought we would finish with something not specifically related to an investment, but more about an investment mindset. So to finish us off today, here's Paul talking about how it's important to always back your own instincts.
I can't underestimate the importance of backing your own instincts, backing your own convictions. Obviously, you've got to do the work to be able to do that. But there's nothing worse than getting something right but not acting on it because you've been talked out of it by the crowd who are focusing very much on short-term issues.
Alrighty, well, Ren, we should thank Paul Moore for joining us on the show today. No, he didn't.
I'm glad you clarified that.
Just for anyone out
it
there.
is an audio podcast, so maybe people thought he was in the room saying those clips.
Oh, God, that was a shocker. Anyway, Ren, I hope... I found that's really interesting. It's always good to hear the thoughts of some very experienced and successful investors. You can always take away bits and pieces from them and add them to the thoughts and ideas of others as well, and start to create your own thesis and understanding of how all of these things work, be it backing yourself and doing your own research, understanding inflation, quantitative easing, all that sort of stuff, all very important to understand. So hopefully we can continue with this and introduce our listeners to another important Australian investor at some point down the track.
Yeah, and hopefully Paul listens to this, or someone in Paul's team listens to this and gets Paul to come on the podcast.
Equity Mates and the people appearing in this program may have positions in the companies mentioned. This is general advice only. Please speak to a financial professional to understand how it may pertain to your individual situation.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.